Ever thought that some of Warren Buffett's strategies might actually seem illogical? That's right. Some are the exact opposite of what you've been told about money. It's interesting, isn't it? We've been taught that investing is all about buying low, selling high, and making quick profits. But what if I told you that one of the world's most successful investors, Warren Buffett, often does the exact opposite? Yes, you heard it right. Buffett, the Oracle of Omaha, has defied conventional wisdom time and again, and his paradoxical strategies have made him a billionaire. Now you might be wondering, what are these strategies? Well, let's talk about a few. For starters, Buffett is famous for his long-term investment strategy. Instead of chasing quick profits, he often invests in companies for decades. Then there's value over price. While most investors focus on the price of a stock, Buffett looks at the value. He's always on the lookout for undervalued companies with strong fundamentals. And let's not forget about patience and discipline. In a world where investors are often swayed by market trends and emotions, Buffett remains calm and composed. He sticks to his investment principles even when everyone else is panicking. This might seem like a recipe for disaster, but it's a key ingredient in Buffett's recipe for success. Intrigued? Well, hang tight because we're just getting started. These are just some of the paradoxical strategies that have made Warren Buffett one of the world's most successful investors. But how exactly do they work? And more importantly, how can you apply them to your own investment strategy? Stick around to find out the surprising contradictions that made him a billionaire. You won't believe number 3. Contrary to the fast-paced trading you might associate with Wall Street, Buffett champions long-term investment. Yes, you heard it right. The Oracle of Omaha himself, Warren Buffett, has always put his faith in the power of long-term investments. It might seem counterintuitive in a world where we are often urged to strike while the iron is hot. So why does Buffett champion long-term investment? Well, let's dive into the rationale behind this strategy. First off, long-term investments are known to bring about substantial growth. This is primarily due to the magic of compounding. Albert Einstein once called compounding the 8th wonder of the world. And who are we to argue with Einstein? When you invest for the long haul, your interest earns interest, and this cycle continues, leading to exponential growth over time. Take the example of Coca-Cola. Buffett bought shares in the company back in 1987. Fast forward to today, and his initial investment has grown over 16 times in value. That's the power of long-term investing. Secondly, long-term investments often prove to be less risky. While short-term market fluctuations can cause panic and lead to impulsive selling, long-term investments ride out these temporary dips. A study by JP Morgan showed that 6 of the best 10 trading days over the last 20 years occurred within 2 weeks of the 10 worst days. Imagine missing out on these opportunities because of hasty decisions. Lastly, long-term investments can offer significant tax advantages. In many countries, long-term capital gains are taxed at a lower rate than short-term gains. This means that by holding onto your investments for longer, you could potentially save a substantial amount in taxes. As Buffett says, our favorite holding period is forever. Now, isn't that a surprise? So next time you feel the itch to buy and sell quickly, remember the wisdom of one of the world's wealthiest individuals. After all, slow and steady does often win the race. While many investors chase after hot stocks, Buffett focuses on value, not price. Now, it might seem a bit confusing, right? Well, let's dive into the difference between these two concepts. Imagine you're at an auction and there's a beautiful painting on sale. The price is the amount you'd pay to take that painting home. But the value, that's a bit more complex. The value might be the emotional connection you feel towards the artwork, the potential for the painting to appreciate over time, or even the prestige of owning such a piece. Now apply this analogy to stocks. The price is what you pay up front, but the value is what the stock could potentially bring you in the future. Warren Buffett's success lies in his ability to spot the difference between price and value. He doesn't focus on stocks that are popular or trending. Instead, he invests in companies he believes have intrinsic value. Companies that, according to his analysis, are worth more than their market price suggests. Now let's take a real-world example. Buffett's investment in Coca-Cola back in the late 80s. At the time, many considered it overpriced. But Buffett saw the value in its strong brand and loyal customer base. He saw a company that could generate profits for years to come. And guess what? He was right. Today, his initial $200 million investment is worth billions. Then, there's his investment in Apple. In 2016, when tech stocks were considered risky and overvalued, Buffett saw the immense value in Apple. Today, Berkshire Hathaway, Buffett's company, owns more than 5% of Apple, making it one of his most profitable investments. So the takeaway here: don't be swayed by price tags. Look beyond the hype and the trends. Consider the long-term potential and the intrinsic value of a company. Remember, price is what you pay, value is what you get. Wise words from Buffett himself. In a world that often rewards instant gratification, Buffett's success is built on patience and discipline. That's right. The billionaire investor is a living testament to the power of these virtues in the realm of investing. Let's delve into the world of patience first. It's an oft-overlooked quality, yet so crucial. Buffett didn't amass his wealth overnight. His fortune is the product of consistent, calculated decisions spanning over 7 decades. It's like watching a tree grow. The growth is slow, almost imperceptible day by day. But given enough time, that tiny seedling transforms into a towering giant. Now, let's consider a real-world example. Consider the case of Coca-Cola. Buffett first invested in the beverage giant back in the late 1980s. The stock's performance over the years was not always stellar, sometimes even languishing. Yet, Buffett held on, his patience unwavering. Today, his stake in Coca-Cola is worth well over $15 billion. Patience indeed is a profitable virtue. Moving on to discipline, it's the other half of the equation. Discipline is about sticking to your investment strategy, even when the market is going haywire. It's about not giving in to the panic when stocks plummet, or the euphoria when they skyrocket. Let's illustrate this with another real-world example. During the dot-com boom of the late 90s, many investors were throwing money at internet companies with no profits or even a viable business model. Not Buffett. He stuck to his principles, investing only in businesses he understood and believed in. When the bubble burst, those who had strayed from their strategy were left in ruins. On the other hand, Buffett, the epitome of discipline, emerged unscathed. To sum up, patience and discipline aren't just virtues. They're the secret weapons of successful investing. They're not easy to master, but once you do, the rewards can be enormous. As Buffett reminds us, the stock market is a device for transferring money from the impatient to the patient. So arm yourself with patience and discipline, and let the market do its magic. So there you have it. Some of the key and perhaps surprising strategies that have made Warren Buffett one of the most successful investors of all time. We've journeyed through the paradox of his unconventional methods, delved deep into the world of long-term investments, and uncovered the hidden treasures of value over price. Not forgetting, of course, the paramount importance of patience and discipline in this high-stakes game of numbers. It's about challenging the status quo, questioning the norm, and finding your own path in the labyrinth of financial markets. Remember, it's not always about following the crowd, but about understanding the underlying principles and making them work for you. So the next time you're contemplating an investment, think like Buffett. Take a moment, step back, and consider the long-term value, the intrinsic worth, and the patience required to let your investments grow. If you found this video helpful, be sure to check out my other video on screen. It's all about Buffett's wisdom on things that poor people waste their money on. Trust me, you don't want to miss it.